columnist for Housing Wire. He's the senior loan manager for a shop out in Southern California, AMC Lending. Logan Mohtashami, welcome, and thank you for joining us.
Pleasure to be here.
I was very nervous about saying your last name. I just got like a little bit frozen inside, and I was like, oh,
it was perfect.
Perfect. So we'll give everybody just a minute or two to start jumping in. I just want to quickly kind of cover what your background is and how you started getting into following things from that macro data perspective. So can you tell us a little bit about where you started in the industry and how you wound up where you're at right now?
Well, our family in general has been in banking since the late 1950s. And we've had our own mortgage company, family-owned mortgage company here since 1987. So I started to work in the business in about 1996. And then, toward the, about 10 years ago, I started deciding, I'm going to do some financial blogging. And then one thing led to another to where I wanted to track basically all economic data all the time. And I think a lot of people know me more for that than anything else. So that's kind of where I've always been in the financial historian mind, since college. But I took it to another stage when I started to blog myself, and then one thing led to another. I became a housing analyst, and now I get to speak at conferences and go on Bloomberg Financial. So it kind of took a life of its own. And if anybody that follows me on social media, it's 24/7 charts all the time.
I did a little digging this morning before our chat, and that is, I'm a data junkie myself, which I don't get to talk about a whole lot right now, but all the projects that we've taken on at AIME and really getting into deep analytics and behavioral profiles and predictive profiles and how all of that works is, you're speaking my language. So I'm very excited to chat with you a little bit more today. We can go ahead and just dive right in because we've got a lot to cover and not a ton of time. Everybody's seen the unemployment claims that are coming in. The job loss that we're experiencing right now is unprecedented across the country, whether that's a combination of people getting laid off, getting furloughed, businesses that are just having to completely shut down for the time being. All of these people are being impacted pretty dramatically. I was telling you just a few moments ago, I know yesterday I heard Texas was quite literally the highest level of unemployment the state has ever seen, which is where I'm located. So what is that impact on the housing industry? What is that going to mean for the next 60 to 90 days?
Well, traditionally, when you have a recession, it's not going to be good for housing in the sense that demand will get impacted. We are at a historical level because we're shutting the economy off. So in theory, 46% of all jobs are at risk because in a service sector economy, jobless claims should rise a lot very quickly. Now, government protocols for lockdowns also means that you're going to get government stimulus as well, fiscal and monetary side. So people that make $46,000 and under are going to get unemployment benefits, $600 added to it. And then on top of that, you're going to get a check for $1,200. That is just basically a Band-Aid until we open up the economy. So traditionally, if we were really losing all these jobs because the economy was bad, we'd be looking at a depressionary state that might take a very long time. But because we chose to, because we had to shut down the economy, the unemployment claims can spike. And then once you get lockdown protocols taken off, slowly and surely, you're going to get some of these jobs come back. And then also part of the grant basically for small businesses to keep people on the payroll. For as long as you can. So it's a very unique set of data because on a historical basis, the jobless claims over 17 million in 4 weeks is more than the last 2 recessions combined.
Right. Yeah, the numbers really are kind of staggering. And as you said, we expect that to continue to climb over the next couple of weeks if we don't start to see some of these shelter-in-place protocols loosen or other businesses that are not technically considered essential being able to open back up again. So just from your perspective, are you expecting things to turn around by the summer to where we do still get some sort of purchase season happening out there? Or are you expecting this to carry a little bit longer?
It's really interesting with housing data. Housing data in 2020 was the best in the cycle. Purchase applications were up double digits year over year. Home sales were at cycle highs. Home prices were actually getting too hot. 8% price growth year over year was extreme in my view. But What you need to do is everyone needs to think of it as a health thing first. And for Housing Wire, I wrote 5 things that everyone should be tracking, because I look at this as BC is before coronavirus, AD is where we're right now. That's after the disease. But at some point, we're going to get an AB. AB means America is back. So right now, the first 2 things is that we got to get that curve down. Now, before we had 1,000 cases confirmed, I thought once we get to 27,000 cases confirmed, and then 6 to 8 weeks after that, depending on where we were in lockdown protocols, we should be able to get the curve flattened. That means about May 18th or earlier. So that would be our first positive sign. After that, we could start talking about when do lockdown protocols take off. And then when lockdown protocols are off, the economy isn't just going to go back to BC like this. Right. So you got to give it about 30 days, and then you should track purchase application data on a year-over-year basis. Because, as hot as we were in the year, we've seen 3 straight weeks of year-over-year declines, 11, 24, and 36%. We could go below, actually have 54% plus year-over-year declines on purchase application. But most of that is due just because we're on a shutdown. So the first and most important thing is we got to get the curve down. Then at some point when it's safe, we take lockdown protocols off, and then we could start determining, how fast we get back to some kind of stable housing market.
Got it. All right. So look at purchase applications. Look at when we see the curve starting to flatten, right? Hopefully by mid-May. I worked in healthcare prior to mortgage. So both the industries that I've worked in are being obviously heavily impacted right now. So there's a couple of graphs that I've got some old healthcare executives that have given me access to that would suggest very similar models, right? That in the next 3 to 4 weeks, we should really see a strong indicator that the curve is starting to not just flatten, but actually decline, where we see those numbers start to go down. And that's another 30 days, you're saying, then to watch those purchase applications.
Because what you really want to see after the health issues is there's a few things to track. Jobless claims, of course, have spiked up. Typically in every kind of recovery, jobless claims will start coming down to credit stress. And one of the problems we see in the mortgage industry is credit is tightening. There's a lot of stress out there. The St. Louis Financial Stress Index is a very good index. It went parabolically to the bad side. It's actually started to come down. You want to see jobless claims fall and the credit stress to fall. But one odd thing that I'm going to say right now, especially for your audience that are mortgage people, you want to see rates go up. You want to see the bond market go up, because when the bond market is telling you that we're still in a recession, things aren't good. When yields start to go up from these levels, that's a positive thing. We don't need the 10-year yield to be below 1% for housing to have another 6 million plus total home sales. But yields going up right now would be a positive sign. We're not there yet. Even with the big stock market rally that we've seen, the 10-year yield is still low. When you see the bond market react well, the bond market is telling you things are getting better. And in fact, right now, the 10-year yield to me is too high. It's telling me that the third and fourth quarter is going to be better, because if we were really going to be in a protracted lockdown, the 10-year yield should be much lower today.
Got it. All right. So we've got some things to keep our eyes on. We will, for everybody that's watching, we'll consolidate that into a graphic so that we can kick it out after we're done chatting with Logan, so everyone can see those things listed out. I was trying to take notes while you were talking, but for anybody that couldn't jot that down, we'll put something together that covers everything.
And it is on Housing Wire. I just came out with that this week, putting the charts on and things to really track on a kind of first, second, third, fourth, fifth stages. That would actually mean, because no matter how many, we could put $15, $20 trillion in the economy, until you open things up, things are not going to be normal. I think that's the most important thing.
Definitely. One of the things that you just mentioned was how we were seeing a spike in year-over-year cost for home purchases, right? You said that 8% increase year-over-year on the cost of homes, being able to buy them across the country. I would assume now we would expect that to fall at the end of COVID, but how is this going to impact purchase prices in the housing market?
This is a very interesting, because traditionally, again, a recession would create distressed sales, would create a damping of demand. Except here's one problem. The COVID recession, we are trying to extend people from foreclosing. So inventory, you see sellers take their homes off the market. So if you're looking for home prices to cool down, that's what you always want to see. Home prices stay between 2 to 3% growth. 8% year-over-year growth is too hot. But if you want to look at if home prices are ever going to come down, you need to see inventory increase a lot. And if sellers are withdrawing their homes, you're just not going to see that kind of velocity. So If you see year-over-year inventory, especially on the national level, if it goes past 6 months, post 1996, we've only had a few years where we had 6 months more inventory. That was from 2006 to 2011. Right now, cycle highs in demand, inventory at cycle lows. So there's just not enough inventory to create real big home price declines. But that's something that people need to start tracking for the next few months. In the next 2 to 3 months, I would say the existing home sales report needs to have an asterisk on it, because once people start to come back out of lockdown protocols, home buying should pick up. So whatever inventory increases we see can be sucked down right away. So, but going out in the future, if you're ever looking for home price declines, you need to see accelerated inventory levels. And the last time we got even near 2000 or 6 months was 2014, when purchase applications were down 20% year over year on trend. We're still far from that. So I think the velocity of inventory is limited because of the lockdown protocols, because of the fact we're not going to let foreclosures happen this year. It'd have to be a 2021 story. So always keep an eye on that supply and demand balance out there. And if inventory starts to get 6, 7, 8 months like they did in 2006 and 7, that's where home prices should decline. Here, it's just not a lot of activity. So the data is going to be really tricky over the next 3 months to read off of any existing home sales report.
So on that, just to dig in a little bit deeper, I've seen a couple of reports coming out from some of the servicers who have relationships either with AIME partners or are partners who are servicers themselves, where the number of people that are filing for forbearance within this first week of opportunity is massive. I know that there are foreclosure halts, right, in a lot of these areas during the forbearance period. But if forbearance is really only given for 90 days at a time from these servicers until you're able to apply for either additional terms of forbearance or loan modification or different type of deferment that would stop you from being foreclosed on, would you expect to see a spike in foreclosures coming out of this first 90-day window?
No, I think that's going to happen in 2021, just because when you're past this, there's 3 months, there's 6 months, there's 12 months. Even if you see delinquencies rise, the foreclosure process, you got to have 90-day delinquencies, then you got the NOD filings. The government is going to do whatever it can to prevent that from happening due to the virus. So the question is, at what point do we get off of lockdown protocols so people get back on work? And then, you can be delinquent in theory, then you're back to your job, you're going to be paying back again. So it's tricky in that sense that in a traditional recession, I would say you need to look at people that bought homes in 2018 and 2019 that don't have a lot of selling equity. That would be the at-risk, legit distressed sales. But because we're prolonging this, it's a 2021 story, if at that. So be careful of reading delinquency data and then assuming that in about 2 months, we're going to have this massive wave of foreclosures. The whole process is going to take so long that it'll be a 2021 story, not a 2020 story.
Got it. All right. Good to know. Good to keep an eye on. I know that's a theory and a concept that's been floating around quite a bit with mortgage brokers on concerns around foreclosures from people who just bought their homes in the last couple of years. So definitely super helpful to understand that this is a very different environment. We're probably looking at 12 months down the road before that happens.
Exactly. And one thing to remember, unlike the last cycle where it was a credit bubble, where cash out booms and 100% financing and option arms, all that, the buyers from 2010 to 2017 are the best we've ever seen in history. Not because they're high FICO scores, good cash flow homeowners. They have nested equity and no exotic debt structures. Because back in 2006, you could have 2 people working and your loan recasted, you're going into foreclosure. Okay, that process has already started. This is much different out here. And also, a lot of people forget this. 20 to 30% of all the homes bought in this cycle were cash. So existing home sales at the peak of the housing bubble was 7.26 million. That was still a 90% mortgage market. Here we're at 5.77 million with tons of buyers that were cash. So those people are not going to foreclose because there's no debt on there. So the loan profile itself is so different than the previous cycle because the demand was so much higher back then and the speculation was so much higher. Now, not the case. But again, anytime you have a recession, late cycle lending is always at risk, 2018, 2019. Typically, usually it's going to be FHA home buyers at that point. But outside of that, you have a lot of people with nested equity. Homeowners themselves are much better now than they were in the previous cycle. Renters, though, that is the area that should be the concern, because you look at 89% of all the jobs that have been jobless claims are low-wage workers. That typically home buyers or homeowners, but you can see it on the renting side. That's where the impact. We see a 14% year-over-year increase on people not being able to make their rent. About 1/3 haven't made their rent right now per the last data. So that's the area that right now would be the most concerning.
So something to keep an eye on if you closed an investment property for a buyer in the last 5 or 10 years, definitely stay on top of what's happening there so that we don't see those buyers start to get into, or homeowners start to get into trouble as well. I've seen a couple of our broker owners actually who have investment properties themselves that are putting nest eggs aside to help cover rent for the next 120 days, anywhere from 3 to 6 months, really, to make sure that they've got a safety net in case they do start to see this happen with their renter.
That's the area of concern that isn't getting a lot of, because we always think of home, the housing market being primary resident, but those that actually have investment properties that have mortgages to them, that's the area of risk outside of, let's say, FHA home buyers from 2018 and 2019. That is an area some people need that rent payment to because they have a mortgage. So that is another area of stress to always focus on.
Got it. All right. I do want to ask you specifically for buyers and sellers in this market right now. So if you do have any of our members that have borrowers out there that are looking to buy a home because they're moving to a new state, they're starting a new job, anybody who's looking to sell their home right now, what would you tell buyers and what would you tell sellers?
I'm going to tell buyers the same thing I've told them for the last 24 years. Housing is the cost of shelter to your own capacity to own the debt. Regardless of what the situation is, you're buying a payment, and that is your shelter cost. So where you have to live somewhere. If you feel confident enough that your situation is not going to change at all, a lot of people are doing that. They're still placing offers. So it's the cost of shelter. I'm not very fond of home buyers that are just sitting and thinking that home prices are going to crash all the time. My advice to them, renting might be a better thing for you for a long time, because you can't have the mindset of trying to time a market. If you're an investor, that's a different thing. Yeah. Again, as bad as the housing bubble and crash was, a lot of people did not just drop their homes. If they can make the payment, they stuck there. So think of it as the cost of shelter. If you're listing or you're thinking of selling, there's two aspects to it right now. If you need a certain price point, you can put your house on the market and see how the market goes. I know a lot of buyers are relieved in the sense that they don't have to outbid anyone anymore. But a lot of sellers are just saying, hey, listen, I'm just going to wait 1 or 2 months. And once lockdown protocols are off, guess what? I'm going to have more buyers into the market. So I think for sellers, it's your own kind of a decision. Some people have to sell. They can't wait. Some people are putting it back. I think every individual has to look at their own financial perspective and see what they need to do. Because I totally understand when some people are just taking their listings off and saying, hey, listen, I'm just going to wait. When lockdown protocols are off, people are going to go back to work. I'm going to get the top dollar. Some people just say, you know what, I'll cut the price of just a few just to get some buyer interest. Everyone has to have their own game plan with each house, whether they're buying a house or listing a house. But it's such a unique situation because, on the other side, we're thinking maybe in a few months, everyone gets to walk the earth again without, social distancing. So this is why we see some sellers just basically say, hey, listen, I'm just going to wait. I don't need it. And I think the bigger story with that is housing tenure has gone up to 10 years. People are staying in their homes longer. From 1981 to 2007, it was 5 years. So people aren't moving as much anyway, and that was one of the reasons why inventory have kind of stayed low. So some people just say, you know what, I don't need to move this year. I could wait. So again, each homeowner has their own kind of perspective and own financial situation to deal with.
That's so interesting. I would have never thought that tenure would have increased over that time frame, but
housing tenure is the biggest story in housing economics. It never gets the attention, and partly of that is that people don't need to move, and I think that's really it is. We've been building bigger and bigger houses for many decades, and our family sizes have been smaller and smaller. So unless you got a new job, lost a job, divorced, more kids, want to go to a better school, most likely the property you're staying in, unless you're a condo and you have to move up to a single family, is suitable for a family for needs. And this is one of the reasons why inventory has stayed low. And down the line, that might be a problem in terms of home price growth growing too fast. But the fact that housing tenure has doubled in this cycle is the most significant housing story, I believe.
One more piece of data to keep our eyes on to know what's going on for the next couple of years and see how this economy is going to recover. So, Logan, I have one last question for you before we wrap it up. If there was one thing, and I know you've put together a list of 5 and you've written columns on what to watch and how to watch it, but if there was one specific thing that you could tell our members to do, coming from the broker community, working with consumers in their local communities, what is the one thing they should be doing over the next couple of months to make sure they're set up in a position that's really strong coming out of this crisis?
Once lockdown protocols are taken off, okay, we're not going to go back to the races, but you got to set yourself up for, having millions of Americans come back out again. The velocity of data is so extreme that we went into a recession basically in 11 days. And I'm not talking just a garden variety recession. We just went to a shutdown. So what gets you to the shutdown is the same thing that's going to get you out. Once you start seeing, better new cases, start prepping, because at some point they're going to let people out again. And when they let people out again, people are going to go to consume. They might not go to, basketball games or baseball games or something to the same manner. But because some companies are down 90% year over year in revenue, OpenTable has data that's down 100% year over year. Okay, you're working from such a low bar that just even a 20% increase is going to be, extreme to the upside. So at some point, there's that light's going to be coming out there. So be mindful of that. Don't kind of take the extreme bearish case that we're going to be in lockdowns for a year or two. We will get rid of this. That's what we do as Americans. The world is going to fight this as World War III, and eventually we move on. You don't want to get yourself so stuck into a kind of Han Solo frozen stage, and you're not ready to kind of jump out there again, because your competitors will.
Exactly. That's exactly what I was going to just piggyback on and say. Watch for those early indicators so that you're setting yourself up and you're prepared once you really do hit this full-blown recovery that we would expect to see trending up pretty quickly coming out of hopefully the end of May and into June, where we start to see recovery happen at a very rapid pace. If you're going to invest in your companies, do it right now. Put the new technology in place, hire another LOA, hire another processor, because if you wait until the recovery is started, you're going to be behind. You're not going to have the capacity to invest in training at that time. So watch those early indicators that Logan is referencing. Those are the things that are going to tell you when it's really time to giddy up and get yourself in a position to be prepared to take on even more business than you currently have. And I know we've got a lot of members that are busier now than they've ever been before. Those numbers are just going to spike coming out of this. There's going to be a lot of people flooding the market with a lot of questions once they have that access to cash again.
Yes, exactly. And in this industry, we all know it's about the hustle. So if you're not doing it, someone else around you is ready to come in out there. So you don't kind of want to lose that edge. You got to get yourself. And the history of life is that whenever you have these really deep recessions, there's always people that get themselves ready to come on top, and that's just how Americans are. That's how we've always been.
Team broker, get yourselves ready right now.
Yeah.
Logan, thank you so much for joining us. We really appreciate it. Anybody, if you have questions, drop them in the comments. We'll kick them over to Logan, see if we can get some answers. A lot of what he said was outside of my wheelhouse, so we're going to do some more digging and see if we can get that into some beginner's terms for y'all to consume as well, so that we're able to understand exactly what it is, because he's doing stuff at a level that a lot of us can only dream about being able to operate right now. So Logan, thank you so much for joining us. Everybody will be back in a couple hours. I think Peter Galvez is on later today with Anthony. Thanks, guys.